Welcome to the Deep Dive, the show that really aims to give you that shortcut to being well-informed.
That's right. We don't just skim the headlines. We take the detailed financial source material, the research, the indicators, analyst notes.
And we boil it down into what you really need to know.
Exactly. So today we're doing a sector analysis. We've used a market screener to pull the top 3 stocks in the consumer defensive discount stores sector.
Okay, who do we have?
We've got the giant Walmart, ticker WMT, then Target, TGT, which has that high yield but, well, has faced some challenges.
And Dollar Tree, DLTR, that one feels like it's always got some volatility going on.
Precisely. So our mission today is to go beyond just the surface news. We're going to give you a focused report on these 3.
Right. For each one, we'll break down the key data points. We're talking valuation, financial health.
Yep, recent news drivers and technicals looking for those potential buy or sell signals in the charts.
And we'll wrap each segment up with our paper money math. It's a fun little thought experiment.
Yeah, we'll take a hypothetical $5,000, see what might have happened if you'd invested it last week. Just gives you a feel for the recent momentum.
Okay, sounds good. Now, before we jump into the numbers, we absolutely have to be clear about this.
Oh, definitely.
All the analysis we're presenting here, it's based strictly on the source data we have. It's for educational context, showing you how markets work.
It is absolutely not investment advice, just laying out the information for you.
Okay, disclaimer done. Where do we start? The biggest one.
Let's do it. Let's start with the heavyweight, Walmart, WMT.
Right. Walmart. I mean, the scale is just immense, isn't it?
Yeah.
Market cap nearly $859 billion. Completely dwarfs the others in this group.
It really does. And that size comes with some interesting valuation numbers. The PE ratio is pretty high, 40.64.
40. Wow. That's steep for a retailer, isn't it?
It is. The forward PE is a little lower, around 36.64, but yeah, it tells you the market has really high expectations baked in. They believe in Walmart's future.
So they're not just pricing in current performance, but like future growth and maybe transformation.
Exactly. And you see that reflected in the projected EPS growth for next year, expected to be around 12.59%, which is healthy.
And they achieve that.
No.
Sales growth over the past 5 years was, what, about 5.4%? Not exactly explosive for that kind of PE.
Right. It's not about just top-line growth. It's about efficiency.
Okay.
Unmatched operational efficiency, really.
Okay, that makes sense. Which brings us to financial health, the balance sheet. Return on equity, ROE, looks strong, 24.46%.
Very solid ROE. But yeah, let's talk liquidity, because those ratios might jump out at you. Quick ratio is 0.23. Current ratio is 0.79.
Less than 1 on the current ratio. In a lot of industries, that would be a major red flag. But for a massive retailer like Walmart.
Yeah, it's a different game. For them, low, quick, and current ratios usually mean they are absolute masters of inventory. They turn it over incredibly fast.
So they're selling goods almost before they even have to pay their suppliers for them. Less cash tied up.
Pretty much. And importantly, this isn't fueled by risky debt. Their debt-to-equity ratio is just 0.72. That's relatively low. They run lean, but it's sustainable.
Okay, so that operational strength and stability provides the platform for, well, the big news, right? The AI stuff.
That's the headline grabbing attention. The partnership with OpenAI, using ChatGPT for shopping experiences. That narrative has really pushed the stock near record highs.
The market sees them as ahead of the curve on AI transformation.
It certainly seems that way. And the analysts agree. The consensus recommendation is 1.24. That's a strong buy.
And the technicals back that up.
They do. The stock's confirming a strong uptrend. It's trading above its 20-day, 50-day, and 200-day moving averages, all positive signals.
What about momentum indicators, like RSI?
The RSI, the Relative Strength Index over 14 days, is at 65.12. That shows strong momentum, but it's not quite in that overbought territory yet, which is usually above 70. So still looks strong, but maybe getting a little extended.
Okay, so if you're watching the price action, what are the key levels? Potential triggers?
Well, given the strength, a clean buy signal could be a confirmed break above the previous 52-week high. That was $109.57. A move above that signals breakout continuation.
And if you're a bit more cautious, looking for a pullback.
Then you might watch for a dip back towards the rising 50-day moving average for support. That's currently around $107.73. Could be a lower risk entry point if it holds.
All right, let's do the paper money math for Walmart. Hypothetical $5,000 invested last week. Let's use that $107.73 price.
Okay, $5,000 at $107.83 gets you roughly 46 shares.
And Walmart's performance last week, the perf week figure.
It was strong, up 5.78% for the week.
So 5.78% gain on $5,000. What's the estimated profit?
That works out to about $286.41 in paper profit.
bringing the total hypothetical value to, what, $5,286.41.
Yep, $5,286.41. A nice steady gain, likely fueled by that AI optimism we talked about.
Okay, solid start with a giant. Now let's pivot. Let's talk Target. Ticker TGT, quite a different beast.
A very different beast, yeah. We're going from that $859 billion market cap down to about $41 billion for Target. Much smaller scale.
And the valuation reflects that difference, right?
Night and day. Target's PE is way lower, just 10.59. That often signals market skepticism, maybe some perceived risk.
But there's one big number that jumps out for Target, the dividend yield.
That's the main draw, arguably. A really high yield at 5.02%. And the payout ratio, around 50%, looks sustainable on the surface.
Okay, 5% yield is definitely attractive for income investors, but let's push on that a bit. The sources mentioned negative EPS growth projected for Target over the next 5 years, like minus 1.99%.
That's the concern, yeah. Negative earnings growth projected.
So if earnings are expected to shrink, doesn't that make that juicy 5% dividend look, well, a bit shaky? More like a potential value trap.
That's the critical question, isn't it? It highlights the structural risk. The market seems worried about their long-term profitability and ability to compete.
And we see that risk reflected in the debt levels, too.
We do. Compared to Walmart's 0.72 debt to equity, Target's is much higher at 1.32.
Significantly higher leverage.
Right. Now, their return on equity is actually quite strong, 26.32%, even better than Walmart's on paper, but
the higher debt and the lack of clear future earnings growth make that ROE and the dividend seem riskier.
exactly. It paints a picture of a company maybe struggling to find its footing.
And the recent news seems to confirm that struggle. Lots of analyst downgrades.
Yeah, the sentiment has turned quite pessimistic. Multiple downgrades recently, pushing the consensus recommendation down to 2.82. That's hovering between hold and underperform.
Ouch. And the stock price action reflects that sentiment, obviously. Down over 43% in the past year.
Brutal performance, down 43% year over year. And year to date, it's also down significantly, about 33%.
So technically, what does the chart look like? Still trending down.
Overall, yes, it's trading way below its 52-week high, about 43% down from there. Now, interestingly, the very short-term 20-day moving average is positive.
Because of a recent bounce, maybe?
Likely, yeah. But the more important intermediate 50-day average and the long-term 200-day average are both pointing down. The bigger trend is still bearish.
So if someone is looking for a bottom, a genuine reversal signal, what's the technical trigger they should watch for?
The key level is likely that falling 50-day moving average. A decisive break above that and holding it would be a strong signal. It would suggest the intermediate downtrend might be reversing.
And the downside risk, the sell signal.
That would probably be a break below the 52-week low. That's around $85.36. Falling below that would confirm the downtrend is continuing.
Okay, so despite all that long-term negativity, Target actually had a pretty good week recently.
Right.
Let's run the paper money math on TGT.
Right, it's interesting. So $5,000 investment, the share price we have is $90.84. That gets you about 55 shares.
And the perf week figure for Target.
Surprisingly strong. It was up 6.21% last week.
Wait, 6.21%? That's actually better than Walmart's weekly gain.
It is, which is fascinating. So that 6.21% gain on $5,000
Gives an estimated paper profit of $310.26.
making the total hypothetical value $5,310.26.
Huh. Goes to show, even beaten down stocks can have sharp counter-trend rallies. A reminder about short-term volatility.
Absolutely. You can get these quick bursts even in a longer downtrend.
Okay, one more to go. Let's shift gears again to Dollar Tree. DLTR, the volatile one, as we said, market cap around $19.7 billion.
Yeah, this one is characterized by some pretty stark contrasts. The PE ratio is undefined, actually negative.
Negative PE, because they lost money.
Exactly. A big income loss reported $2.93 billion. So no positive earnings on a trailing basis, but analysts are projecting huge EPS growth next year, almost 16%.
Okay, hold on. Lost billions recently, but projected to grow earnings strongly next year. How do you square that circle? Is it all riding on their strategy changes, like moving away from just $1 items?
It seems to be a massive bet on a successful turnaround, fueled by that multi-price strategy and maybe some cost efficiencies. Right now, though, the financial health metrics, They show the struggle.
Like what specifically?
Well, look at return on invested capital, ROIC. It's deeply negative, minus 30.30%.
Minus 30%. Wow. For listeners, ROIC tells you how well a company uses all its capital, debt, and equity to make profit, right?
No, precisely. And a negative 30% ROIC basically means they're destroying value with the capital they're deploying right now. It's a serious issue.
And the debt situation.
Leverage.
Also high. Debt to equity is 2.04. That's significantly higher than both Walmart and Target. So you've got negative profitability combined with high leverage. That's a risky mix.
And the news reflects this volatility. Tariffs, strategy shifts, causing uncertainty.
Definitely. But there was also recent news that investors seem to cheer. They outlined a 3-year earnings growth plan targeting up to 10% annually.
So providing some future guidance.
Right. And like Walmart, they're also talking about adopting AI. Plus, there's this interesting note about their customer base shifting.
Oh, so?
Apparently, they're attracting more affluent shoppers now, people earning over $100,000 a year who are looking for value. So maybe that multi-price strategy is broadening their appeal.
Interesting dynamic. Okay, technically, how does this volatile stock look? It had a monster week, didn't it?
It really did. The strongest weekly gain of the three by far, up a huge 10.08%.
10% in a week. Yeah. And the charts confirm high volatility. The ATR, average true range, is high, meaning big daily price swings are normal. We also see high short interest.
What's the short interest figure?
It's at 9.36%. That means nearly 10% of the available shares are being shorted, people betting the price will go down.
Which can be fuel for a squeeze if the price keeps going up.
Exactly. If positive momentum continues, those short sellers might be forced to buy back shares to cover their positions, pushing the price even higher. It's called a short squeeze.
So key technical levels for DLTR: resistance and support.
Right now, it seems to be bumping up against resistance near its 50-day moving average. A decisive break above that SMA 50 would be a bullish buy trigger, suggesting the intermediate trend could be turning positive.
And the sell trigger, given the volatility.
If it fails to hold this recent momentum, maybe falls back below the 20-day average, or especially if it heads back towards that 52-week low near $60.49, that would be a clear sell or short signal.
All right, time for the final paper money math. This could be interesting given that 10% weekly gain. $5,000 into DLTR. Share price is $96.44.
Okay, $5,000 at $96.44 buys you approximately 51 shares.
And with that 10.08% gain last week.
The estimated paper profit jumps significantly. It's about $495.89.
Wow, making the total estimated value $5,495.89.
Yep, $5,495.89. So Dollar Tree was the clear winner for the hypothetical one-week investment, really showcasing that high-risk, high-reward profile.
Okay, let's try and synthesize all this. We've dug into the data for these 3 discount retailers.
Walmart. Walmart offers stability. It's got that AI-driven momentum, very low structural debt, but it comes with a pretty rich valuation, high expectations are baked in.
Then Target.
Target gives you that tempting high dividend yield, but you have to weigh that against higher debt, significant analyst skepticism recently, and those worrying negative long-term earnings projections.
And finally, Dollar Tree.
Dollar Tree is the pure volatility play, it seems. It delivered that huge hypothetical weekly return, almost $500 profit on $5K. But that upside potential comes with major risks: negative current income, poor capital efficiency shown by that awful ROIC, and high debt. It's a turnaround story you have to really believe in.
So we used the deep source material, went beyond just the headlines, looked at jet, valuation, news, technicals, AI strategies, the whole picture for you.
Right. Which leads us to maybe a final provocative thought for you, the listener, to consider.
Okay, let's hear it.
Given what seems to be happening in the broader economy, you hear reports that wealthier shoppers are boosting spending, while lower income earners might be pulling back. How does that play out for these 3?
Interesting question.
How will Dollar Tree's multi-price strategy and its new, wealthier customer base fare? How does Walmart's sheer scale and AI innovation position it? And where does that leave Target, which seems to be caught in the middle?
Yeah, which of these retailers is ultimately best positioned to capture that value-seeking consumer, potentially across all income levels, as things move forward?
Something to think about. Which strategy wins in this environment?